Now, back by popular demand, it's the Lance Roberts Show.
And welcome to the show this morning. It's 6:06 as we kind of get things underway here. Of course, this is the Friday Eve edition of the show. Of course, we're just getting ready to wrap up the week here. It is Thursday. It's always a good day of the week. A few things to go through today. We've got some funny stories as well today, but talking a little bit about kind of where we are over the course of this week. Last weekend was when the whole issue with tariffs kind of went underway and pressure on the markets really kind of occurred on Monday and Tuesday. Now, yesterday we actually managed to muster kind of a rally together yesterday, really kind of over the last couple of days. Now, one thing that's interesting is that the market's rallying in the mornings, which is good, but we are getting a sell-off in the late afternoon. So institutions tend to trade at the end of the day. So looking at, kind of the price action itself, the markets have been trying to recover here over the last couple of days. Of course, we had a strong sell-off really over the last couple of weeks. So the markets did get oversold on a short-term basis. So not surprising here when we look at kind of the market dynamics. The markets had gotten under a bit of selling pressure here. Not surprising that we're getting a rally at this point. But the important thing, again, is that we're still simply in this correctional process that began a couple of weeks ago. Even before this whole trade disruption came to light, the markets had already kind of started sniffing out something was going on. And as we wrote about a couple of weeks ago, in our newsletter, we said, hey, look, take some profits here, reduce some exposure to the markets, particularly from the fact that we've had this very strong rally from the beginning of this year. We're up about 13% for the year, and we're about to move into the summer months. Now, summer months just typically tend to be weaker in terms of performance for a variety of reasons. But primarily just, and particularly the case after you've had such a strong run, it's very likely the markets are going to step back, they're going to correct, and then that gives the market some ability to rally heading into the end of the year. So watch this current correction now. We're about to run back into the 50-day moving average. That's going to provide a little bit of resistance here, particularly since we had kind of a cluster of price action over several days, kind of holding right at that level previously. So we're about to run back into quote unquote traffic in terms of price. And if you live in Houston, you know what traffic's all about. So we're about to get back into that level. So, pay a little bit of attention here. And again, don't get too excited that, we've solved the problem. The market rallied yesterday on news that the Trump administration is going to postpone tariffs on European automakers. That's fine. But when you take a look at things of what's happening in the real economy right now, there is a dramatic slowdown that is going on. Recent data from the case freight index shows a sharp slowdown in what's happening in terms of transportation. We're looking at global manufacturing activity has dropped to levels that are normally equivalent with deep recessions in the economy. And if you take a look at a lot of our economic data that came out yesterday, very weak, really kind of across the board. Industrial production, retail sales, all substantially weaker than was expected. And not surprising because, again, as we kind of foster this, and we take a look at, say, import prices, and we take a look at where those import prices wind up because of tariffs, it is the consumer that's paying basically all the freight in terms of the tariffs currently. And this was an article in the Wall Street Journal this morning talking about this very thing. So again, when you talk about consumers that are already very cash strapped to begin with because they carry a lot of household debt, small changes to prices will very quickly show up into the activity of the economy and the market. So again, when you start taking a look at what's happening with imports, there's been a big slowdown in imports because, well, consumers are consuming less. We're not importing less, it's just simply because we've decided not to. Imports are driven by demand. And so if consumers are demanding less goods in terms of imports, we're going to import less. Now, go take a look at that GDP report in the first quarter, 3.2%. Everybody was very excited at the headline. The problem is that was driven by two things that are not good economically. One, you had a build in inventories. If you have a build in inventories, that means that companies are producing stuff, but consumers aren't buying what they're producing, so the inventory stacks up on the shelves. So that's not a good sign economically. The second thing that provided a big boost to that first quarter report was the differential between imports and exports. That's called net exports. And we imported less, we exported more than we imported, and that provided a boost to the economy. But that means that, or at least that suggests that, consumption is slowing in the U.S. Now, again, the GDP report that comes out for the economy is 70% driven by what we consume. So taking a look at inventories and taking a look at what's happening with imports tells us a whole lot about the bigger picture of what's happening with the economy. So again, this market's been rallying on the back of weaker economic outlooks as well as weaker earnings growth. And again, yes, companies are beating earnings. Walmart just came out today. They beat earnings. Very, very good. Everybody's very excited about that. But those estimates had been lowered by almost 15% for them to beat that number. So in other words, I lowered the bar so Walmart could beat it. That a lot of this is also being driven by stock buybacks. In the last quarter, companies bought back $180 billion worth of stock. Buybacks are making up about 80% of this activity that's occurring that's driving the market. So retail investors really aren't driving this market. They're in it, but they're not driving it. What's driving this market has been corporate share buybacks. We have a really good report on our website talking about the importance of share buybacks and what it means. And of course, we go through the entire debate. There's a lot of people that say share buybacks are great. We need to do it. Share buybacks have become a political football for politicians. And, there's been some discussions about trying to legislate a reduction in share buybacks. So we've got a whole article, and it's called the Stock Share Buyback Debate. It's on our website now at realinvestmentadvice.com. I encourage you to read it because if you don't really understand what share buybacks are, it's a really good kind of primer on understanding what's happening, why it's happening, and what the net effect is to you as employees and why your wages haven't been growing has a lot to do with that. Be right back after the break. I've got a couple of important things to get through with you today, and so we'll get into those right after the break, right here on the Lance Roberts Show, realinvestmentadvice.com.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at lancerobertshow.com.